What does it truly mean for a business to be doing well? Is it just about making a big profit?
Hmm.
Or is there maybe a deeper story to uncover?
Hmm.
Imagine you hear a company made, say, $1 million in profit last year. Sounds
On
great.
the surface, sure.
But on its own, that number just kind of hangs there. It lacks crucial context.
Exactly.
You don't know if that's an improvement or maybe a step backward from previous years, how it stacks up against competitors, or even, what kind of investment it took to generate that money.
It's just a raw figure. It doesn't tell you much in isolation.
Right.
And that's precisely why we're doing this deep dive today.
Okay.
Our goal is really to give you the essential tools, specifically financial ratios that transform those raw numbers from financial statements into genuinely meaningful, actionable insights.
Right. Getting behind the numbers.
Yes, we're
Yeah.
pulling from some pretty comprehensive materials here to give you a shortcut, if you like, to being well informed about a business's health and its true potential.
So our mission today is to cut through the jargon, look beyond the surface numbers, and really uncover how these figures, when you look at them the right way, tell a much richer story.
More dynamic story.
Yeah. It's about empowering you, the listener, to understand the real position and, I suppose, the future prospects of any company you might look at.
Absolutely.
Okay, let's unpack this then. Why are those raw numbers, like that $1 million profit we mentioned, just not enough on their own?
Well, to truly put any financial figure into perspective, you really need to look at it through, let's say, three critical lenses.
Okay, three lenses.
First, you absolutely have to compare it to previous periods, previous years, previous quarters, whatever makes sense.
Right, for trends.
Exactly.
Yeah.
This immediately helps you spot trends. Are things improving, getting better? Or are there maybe some worrying signs emerging, negative trends?
Makes sense. What's the second lens?
Second, you need to establish ratios. This means comparing one figure to another within the same set of financial statements.
Ah, okay, connecting the dots.
Precisely. Think about it. If an owner put in, say, $100,000 at the start of the year,
Mm-hmm.
and the business then generated that $1 million in profit we talked about, well, that's a phenomenal 1,000% return on their investment.
Wow, okay. Suddenly that $1 million means a lot more.
It has immense significance now because it's relative to the capital that was put in.
Got it. And the third lens?
And third, context again. You must compare those results, those ratios, with similar businesses in the same industry or against some kind of external benchmark.
Like other companies?
Yeah, or even something simple. Go back to our 1,000% return example.
Mm-hmm.
If you compare that to what you might get from, say, putting your money in a fixed deposit at the bank,
Right, much lower.
much, much lower, then you can say, yes, that 1,000% return is genuinely phenomenal. It's all about perspective, about context.
So these ratios give you that context. Who actually uses these insights then? I mean, what does this mean in the real world?
Oh, the audience is incredibly broad. Really, ratio analysis is a vital tool for management, people actually running the company day to day.
Trying to scare the ship, yeah.
Owners, definitely. Shareholders, potential investors evaluating opportunities, even employees who want to understand the stability of their workplace.
I hadn't thought about employees, but that makes sense.
Creditors, financiers lending money, banks, even government bodies use them to gauge a company's financial position and its potential for growth, or conversely, its risk profile.
So pretty much everyone with a stake in the business.
Essentially, yes.
Yeah.
Any stakeholder. These ratios, they're quantitative analyses, number-based analyses of a business's liquidity, its profitability, leverage, growth, profit margins, rates of return, all derived from the core financial statements.
The profit and loss, balance sheet, cash flow.
Exactly. The statement of profit or loss, statement of financial position, statement of cash flows, all the key documents.
That's a huge range of uses, and it makes sense why they're so crucial. So now that we know who uses them, let's dive into how they use them. Let's explore the specific types of ratios that paint this full picture.
Sounds good.
We're diving into solvency, profitability, liquidity, and asset management ratios. Each one, as you said, tells a different, crucial part of the story, gives us a more complete understanding.
That's right. Let's start with solvency ratios.
Okay, solvency.
Think of solvency as a company's long-term endurance, its staying power. Does it have the financial muscle to not just pay next month's bills, but to handle all its debts, even those due years down the line?
So looking further out.
Yes, it's about fundamental financial health over the long haul, ensuring the business can stay afloat.
And how do we measure that?
The main one is the solvency ratio. It specifically looks at how a company's total assets compare to its total liabilities.
Assets versus debts?
Simple as that. total assets divided by total liabilities, usually expressed as X to 1. So if its assets comfortably outweigh its obligations, the business is solvent.
Which means low risk.
Low probability it will default on its long-term debt, exactly. But if liabilities start to exceed assets, so the ratio drops below 1.1,
Uh-oh.
that's a red flag. Indicates potential insolvency, a higher risk of default down the road.
Okay. With that in mind, let's look at one of our examples, Amanzi Traders. Their solvency ratio for year 20.4 was 1.65 to 1, and that showed steady improvement from 1.47 to 1 in 20.3 and 1.33 to 1 in 20.2. What does that progression tell us?
Well, that's a very positive trend for Amanzi, no question.
Getting stronger.
Yes, it indicates they're building a stronger financial foundation. Their assets are increasingly covering their liabilities year on year.
And why was that happening?
Looking deeper, this improvement seems largely due to increased current assets, things like inventory and what customers owe them, trade receivables alongside a decrease in their non-current, their long-term liabilities.
So for someone lending them money long term.
For a lender or long-term investor, this signals a lower risk of default, a more robust balance sheet. It's definitely a good sign.
Okay, that's solvency. What's next?
Next up, we explore profitability ratios.
Right, the bottom line stuff.
As the name suggests, these ratios were all about a company's ability to actually generate profit from its operations. They reveal how efficiently a business is turning its sales into actual earnings.
Makes sense. Which ones are key here?
Well, a fundamental one is the gross profit percentage.
Gross profit. That's sales minus the direct cost of the goods.
Exactly. This ratio essentially asks, after paying for the direct cost of the goods sold, how much profit is left over from each dollar or rand or pound of sales. It's a key indicator of a company's ability to sell products cost-effectively.
How well they manage those initial costs?
Yes, and their pricing power too.
Okay, so for Amanzi Traders, this ratio, it declined from 33.47% in 20.2 down to 29.36% in 20.3, and then further to 28.21% in 20.4. That seems like a problem.
It is. It's a real concern, especially as noted in the source, their target markup was 50% on cost.
Which translates to?
That translates to a 33.33% gross profit percentage.
Yeah.
So they're falling short of their own target, and the trend is downwards.
So what could be causing that decline?
This really signals a potential challenge to their core business model. A declining gross profit percentage means they're either, well, selling goods for less than perhaps they should.
Discounts? Competition?
Could be. Or their cost of acquiring those goods is increasing disproportionately. Maybe supplier costs went up. It could also point to issues like significant inventory losses.
Like theft or damage.
Theft, damage, obsolescent stock just getting old and unsellable at full price. Or maybe aggressive clearance sales to shift that old stock.
So it forces them to look hard at how they buy and sell.
Absolutely. It directly impacts their long-term viability if they can't maintain healthy margins. Now, contrast that with Skinstead dealers.
Okay, what about them?
Their gross profit percentage for 20.7 was 45.55%.
Wow, that's high.
It's not just favorable, it's notably higher than the industry average benchmark of 40%. And it was an improvement over their own previous years, too.
So they're doing something right.
It tells you they're likely excellent at sourcing their goods, managing costs, pricing effectively, or maybe a combination of all three. It's a significant competitive advantage.
Okay, gross profit. What other profitability measures?
Then we have the net profit percentage. This one takes it a step further.
How so?
It looks at how much profit is left from each dollar of sales after all costs have been accounted for. Not just the cost of sales, but also operating expenses, rent, salaries, marketing, interest payments, taxes, everything.
So the final slice of profit from sales.
Exactly. It's a measure of overall efficiency in managing every single expense the business incurs.
And for Amanzi Traders, more bad news.
Unfortunately, yes. A continued decrease here, too, from 19.18% net profit in 20.2, steadily down to just 8.21% in 20.4.
Ouch. What does that tell us beyond the gross margin issue?
Well, the continued decline in net profit alongside their gross profit problems shows a sort of a broader erosion of profitability. The analysis suggested their operating expenses weren't excessively high, maybe just inflationary increases.
So the main culprit is still that weaker gross margin.
It seems the core problem really lies in their initial profit margins from selling goods. That's dragging everything else down.
And Skinstead dealers, how did they fare on net profit?
For Skinstead dealers, their net profit percentage was around 11% in 20.5 and 20.6. Now, compared to an industry average of 15%, that suggests they're actually underperforming the benchmark here.
Interesting. Good gross margin, but lower net margin than average.
Correct. Which tells us that even with those good gross margins, they might be carrying higher operating costs or perhaps higher interest expenses, something else that's eating into their final profit compared to their peers.
So you need both measures to get the full picture.
Definitely. And finally, for profitability, let's touch on the return on average owner's equity, or ROE.
Okay, ROE. This one's for the owners.
Yes, this ratio focuses squarely on the shareholders or owner's perspective. It asks, for every dollar of equity the owners have invested in the business, how much net profit is actually being generated?
So how hard is their money working?
Precisely. It measures how effectively the company is using the owner's capital to create earnings.
Manzi traders again. I'm guessing another decline.
A significant deterioration, yes, dropping from a very high 65.28% in 20.2.
Wow, 65% return.
That was outstanding, but it fell all the way down to just 13.28% in 20.4.
What does such a drastic drop signal to those owners or maybe potential investors?
That is a flashing red light for owners. A return of over 60% on equity is fantastic, but falling to below 14% indicates a severe decline in the company's ability to generate profit from the owner's investment.
Their capital isn't productive anymore.
The efficiency of the capital they've put into the business has plummeted, largely due to those declining profits we've already discussed.
And Skinstead, how did their ROE look?
For Skinstead dealers, their ROE figures were around 18% compared to that industry average of 20.5%.
So again, slightly below average.
Yeah, while not a disaster like a Manzi's drop, it suggests their equity isn't working quite as hard for them as it perhaps could be, relative to their competitors in the industry.
Okay, that covers profitability. Let's move on. What's the third category?
Our third category is liquidity ratios.
Liquidity. Paying the bills.
Exactly. If solvency is about long-term survival, liquidity is all about a company's immediate ability to pay its short-term bills. Things due right now or very soon.
Got cash on hand.
Essentially, yes.
Yeah.
Think of it as having enough cash or easily convertible assets, things you can turn into cash quickly to cover what's due in the next few weeks or months.
Okay. And the key ratios here.
Well, the most common one is the current ratio.
Right, I've heard of that one.
It compares a company's current assets, things like cash, inventory, and what customers owe them, trade receivables, to its current liabilities, which are the bills due within the next year, usually sooner.
So short-term assets versus short-term debts.
Exactly. It gives you a snapshot of whether a company has enough short-term stuff readily available to cover its short-term bills.
Okay, Amanzi traders. Their current ratio actually improved steadily, from 1.51 to 1 in 20.2 up to 2.55 to 1 in 20.4. It comfortably met the general guideline, the norm of 2.1 in the last 2 years. So on the surface, that sounds great, doesn't it?
It does sound good, yes. A ratio above 2.1 generally suggests healthy short-term liquidity.
But I sense a but coming.
Well, while generally positive, a rapidly increasing current ratio, especially in Amanzi's case, given their other issues like declining gross margins, it can sometimes mask underlying problems,
Such as
an accumulation of inventory that isn't selling quickly. Remember, we suspected obsolete stock.
right. So the assets are there, but maybe they're not very liquid assets.
Precisely. It looks like they have plenty of assets on paper, perhaps too many in the form of inventory. But if those assets, particularly inventory, aren't converting into cash efficiently, then that liquidity strength on paper isn't quite as solid in practice.
Okay, that makes sense. You need to look deeper.
Which leads us neatly to the next ratio, the acid test ratio.
Acid test. Sounds harsh.
It is. It's also known as the quick ratio. It's a more stringent test of liquidity because it specifically excludes inventory from the current assets calculation.
Why exclude inventory?
Because inventory isn't always easy to convert to cash quickly.
Yeah.
You have to sell it first, maybe collect the cash. The acid test asks, can a company pay its immediate bills using only its most liquid assets? Basically cash and receivables, things that are already cash or very close to it.
So a real quick check for cash availability?
Exactly.
And Amanzi's acid test ratio.
It showed a slight increase, actually, up to 1.17 to 1 in 20.4 from 1.07 to 1 in 20.2. So comfortably beating the typical 1.1 norm or benchmark.
So even without inventory, they look okay.
Again, on the surface, yes. However, a closer investigation, looking at the components, reveals that their actual cash resources have decreased. They're even in overdraft.
Oh.
And meanwhile, their trade debtors, what customers owe them, have continued to increase, even while their sales have decreased.
Hold on. Sales down, but receivables up. That doesn't sound right.
It suggests they're having trouble collecting the money they are owed. So what does this tell us about the quality of their liquidity, despite that seemingly healthy acid test ratio?
It tells us it's not very high quality. The ratio looks okay, but the cash isn't there, and the receivables might be hard to collect.
Exactly. This is a classic example of how a single ratio can be misleading without digging into the details. While the ratio itself looks acceptable, the underlying components tell a concerning story. Low cash, high receivables despite falling sales. It points to a major cash flow problem.
They might be liquid on paper, but...
But if that liquidity is tied up in uncollected debts or potentially unsellable inventory, as we suspected earlier, it's not truly available to pay the bills,
So their current assets just aren't turning into cash effectively.
which is a major operational challenge, big time.
Okay, liquidity is critical but complex. What's our final category of ratios?
Our final category is asset management ratios, sometimes called efficiency ratios.
Asset management, using your stuff well.
That's a good way to put it. These ratios measure how efficiently a company uses its assets, its inventory, its buildings, its receivables to generate sales and manage its operations. It's really about how hard their stuff is working for them.
Right. What are the key ones here?
Let's start with the average debtors collection period.
Debtors collection. How fast you get paid by customers.
Precisely. This measures, in days, the average time it takes a company to collect the money owed to it by customers who bought on credit. It's a critical indicator of cash flow health. How quickly are those credit sales turning into actual cash in the bank?
Okay. And for Amonzi traders, given what we just discussed about their receivables.
You guessed it. Not good. The collection period significantly increased to almost 47 days, 46.79 days in 20.4. That's a huge jump from around 28 days back in 20.2.
47 days. That's over a month and a half wait to get paid, on average.
Yes, and this is a major concern. What's the real impact of that?
It's got to be terrible for their cash flow.
Absolutely. This is likely the single most important contributor to Amonzi's poor cash flow situation. When it takes that long to collect payment, that money is effectively tied up. It's unavailable for paying suppliers, paying salaries, investing.
They're basically acting like a bank for their customers, but not getting paid interest.
In effect, yes. They're financing their customers for a longer period, which strains their own working capital severely. Even if sales numbers looked okay on paper, which they didn't, but even if they did, if the cash isn't coming in, the business struggles to pay its own bills.
And Skinstead, were they better at collecting?
Much better. Their collection period was around 27.5 days in 20.6, compared to an industry average of 31 days.
So faster than average.
Yes, that's a healthy sign. They're getting their cash in faster than their peers, which helps everything else run more smoothly.
Okay, so collecting from debtors, what's the flip side? Paying suppliers.
Exactly. That's the average creditor's settlement period. This measures the average time, in days it takes, for the company to pay its own suppliers for goods or services bought on credit.
How long they take to pay their bills.
Correct.
And Amonzi. I bet they started scratching their payments.
They did. Their settlement period increased to over 62 days, 62.28 days in 20.4. That was up from around 51 days in the previous years.
62 days. So they're taking 2 months to pay suppliers now? What's the connection to their cash flow issues?
It's a direct consequence. Because they're taking so much longer to collect cash from their customers.
They don't have the cash to pay their suppliers.
Exactly. They're forced to take longer to pay their own suppliers. Now, while delaying payments can provide some temporary breathing room for cash flow,
It can't be good for relationships, right?
it can definitely strain supplier relationships. Suppliers might start demanding cash up front, offer less favorable terms, or in the worst case, even refuse to supply them. It's a risky game to play long term.
What about Skinstad's payment period?
Interestingly, Skinstad settled faster than average, around 29 days compared to an industry benchmark of 35 days.
So they collect fast and pay relatively fast.
It suggests they have healthier cash flow overall, allowing them to pay suppliers more promptly. And that prompt payment can often lead to better supplier terms, maybe discounts, strengthening their position.
Makes sense. Okay, what other asset management ratios are important? Inventory.
Yes, inventory is crucial. Next, we have average inventory turnover.
Turnover. How fast stuff sells.
Pretty much. This ratio shows how many times, on average, a company has sold and replaced its entire inventory during a financial period, usually a year. Think of it as how quickly products are moving off the shelves and being replaced.
So high turnover is good, means lots of sales.
Generally, yes. A high turnover usually suggests strong sales and efficient inventory management. Conversely, a low turnover can indicate sluggish sales, or perhaps holding way too much inventory.
Okay, Manzi traders. Given our earlier suspicions about obsolete stock,
The numbers confirm it. The decrease in Amanzi Trader's inventory turns is quite concerning. It dropped from a respectable 16.7 times back in 20.2,
selling their whole inventory 16 times a year.
down to a mere 6.15 times in 20.4.
Only 6 times a year now.
Yes, and that falls significantly below the industry average benchmark of 12 times per year.
So, what fundamental problem does this slow turnover really signal?
Well, it strongly reinforces our earlier idea that Amanzi is struggling with obsolete or slow-moving inventory.
The stuff is just sitting there.
Exactly. And when inventory just sits there for a long time, it ties up cash that could be used elsewhere, it incurs storage costs, insurance costs, and it massively increases the risk of spoilage, damage, or just becoming completely outdated.
And it links back to the poor gross margin, too.
Directly. This slower turnover directly supports our speculation that it might be a significant reason for their declining gross margins. Perhaps they're being forced to deeply discount that old stock just to get rid of it, killing their profit margins in the process.
Right, it's all connected. Is there another way to look at inventory speed?
Yes, you can easily derive inventory days from the turnover ratio.
How do you do that?
You simply divide 365 days by the inventory turnover ratio number. This tells you the average number of days it takes to sell the inventory you have on hand. It makes the speed, or lack thereof, even more tangible.
Okay, so for Amanzi, what were their inventory days?
Well, back in 20.2, when turnover was high, it took them only 22 days on average to sell their inventory.
Pretty quick.
Then it slowed to 31 days in 20.3, but by 20.4, with that low turnover of 6.15 times,
Okay, let me guess. A lot longer.
a significant 60 days on average in 20.4.
60 days. 2 months to sell the average item.
Yes. What does that 60-day figure really highlight?
It just screams problem inventory. It
Yeah.
starkly highlights the burden of that stock. Imagine holding on to an item for 2 months before it sells.
All that time, cash is locked up, warehouse space is occupied.
And the risk of it becoming worthless just goes up every day.
Exactly. It's a massive drag on their entire operation.
Wow. Speaking of inventory, let's maybe bring it down to an even more tangible level. We've been looking at these big company numbers, but even really small, everyday inventory issues can impact a business, can't they? Like, take Jason's small shop selling those upmarket wine glasses.
Right. A good simple example. So let's say on March 1st, Jason had 40 glasses in stock, worth $50 each cost price.
Okay.
During March, he purchased 60 more, also at $50 each cost, and he sold 42 glasses during the month.
Seems reasonable.
But before closing his books on March 31st, he does his monthly stock take, counts everything, and finds that, oops, 3 glasses were accidentally broken during the month.
Happens in retail.
It does. Now, assuming he aims for, say, an 80% markup on his cost price, this breakage of just those 3 glasses at $50 cost each.
That's a $150 cost.
That $150 cost will directly reduce his gross profit, and therefore his net profit, for March by $150.
Just from 3 broken glasses.
Exactly. What's fascinating here, I think, is that even seemingly small physical losses, a few broken glasses, a bit of spoilage, minor theft, they directly hit the bottom line.
And ultimately affect those profitability ratios we talked about earlier.
Absolutely. It just underscores the importance of not just making sales, but also meticulous asset management,
Yeah.
even down to counting the stock accurately and minimizing physical losses.
Yeah.
Every little bit counts.
That's a great illustration. So pulling all these different ratios together, what's truly illuminating here for me is how these seemingly simple calculations really bring the underlying health of a business to life.
They tell a story.
Yeah, we've seen how, a high solvency ratio might signal long-term stability, which is good,
Right.
but then a declining gross profit percentage or a really painfully slow inventory turnover can quickly raise massive red flags. Flags for efficiency, for profitability, maybe even for short-term survival if the calf runs out.
And if we connect this to the bigger picture, understanding these financial metrics is, well, it's absolutely crucial for any stakeholder, isn't it?
Seems like it.
It allows you, as an investor, manager, employee, whatever your perspective, to move beyond those superficial headline numbers and truly grasp a company's strengths and its weaknesses,
Whether it's managing costs
or collecting debt sufficiently.
or just shifting that inventory off the shelves.
Exactly. It helps you see the complete interconnected picture of how the business is actually performing operationally.
This deep dive has, I hope, equipped you, our listeners, with some really practical tools to look beyond the headlines and truly understand what makes a business tick.
Hmm.
Now, you're not just seeing, say, a profit number. Hopefully, you're seeing the intricate story behind it, the operational truths that these ratios reveal.
And maybe this raises an important question for you listening. How might you use these ratios? How could you apply them to make your own strategic decisions?
Could be about a company you follow in the news.
Or an investment you're considering? Maybe even just understanding the financial flows within your own small business, or dare I say, your own household finances. The principles apply broadly. The numbers are speaking. Are you listening?